All right, in this video, I'm talking about California's Proposition 19, which in summary basically allows somebody to transfer their property tax basis either to a family member, like in an inter-family sale, or, which is what I'm more so gonna be talking about right here, is for people who are 55 years or older or disabled. And if you fall into that latter category, I'm gonna do a deep dive on exactly what that means. All right, so I got a question from Danny. Danny wants to know about California's Proposition 19. Basically, how does it work? How does somebody take advantage of that? So in this video, I'm gonna talk about just that. Now, one more thing, we put together this awesome down payment assistance guide. It's free. Go ahead and click that link to download it. It's an awesome resource to help you along through the process. So let's talk about Prop 19, which is a law that went into effect in 2021 that allows certain homeowners to essentially transfer their property tax basis. And there's kind of two different paths that Prop 19 covers. And I'm only gonna do a deeper dive on one of them. Now, it does also cover inter-family sales, which basically if, mom and dad wanna sell the house to the kids or the grandkids, there is a way in certain circumstances where grandma and grandpa or mom and dad can transfer their property tax basis to the kids or grandkids. But I'm not gonna talk about that in this video. In this video, I'm talking about the other people that are affected by this, which is if you are 55 years or older, or if you're disabled, then you too can transfer your property tax basis, but not to one of your kids, but instead go buy a different property and basically bring your current property tax basis with you. So let's talk about that. Let's talk about how it works, what the rules are, how you take advantage of it, and some pros and cons. All right, so effective April of 2021, so this has been around for over 2 years, by the way, people that are 55 years and older or severely or permanently classified as disabled can take their taxable value of their primary residence and go purchase a new primary residence up to 3 times the value, and basically you're taking your taxes with you. Now, taxable value means your base year value, meaning the amount that you paid for the property, the initial base price that you paid, plus the inflationary adjustments, the little incremental increases. Even though we have Prop 13, which locks in your base rate, there's still little incremental changes. So if you look at your property tax bill and you look at your factored base tax value, that is what you take with you to the next property. Now, something that's really cool is that there is no limit to the market value of the replacement property. So, you could go buy $1 million house, you could buy a $500,000 house. There is no limit, restriction to what you can purchase. But keep in mind that the amount of purchase price that is in excess of your departing residence will get tacked on to your tax basis. Now, they do leave you a little bit of wiggle room for appreciation, inflation, whatever you want to call it. So basically, if you purchase your replacement property within 12 months of the sale, you could actually buy something that's 105% of your departing residence and still have a true transfer of your tax basis. And if you do it within the second year, they let you go up to 110%. Now, to qualify, there's some rules here. So your replacement property must be purchased or constructed. So if you're doing new construction, it must be built within 2 years of the sale of your original property. Now, most people, they're gonna do it within that time frame. But if you've got some weird circumstance where you don't have to make the purchase of this next property, you're gonna have to get it done in under 2 years or you cannot transfer it. Now, you gotta be 55 years or older, or like I said earlier, be classified as severely or permanently disabled at the time that the original property was sold. So when the property's sold, you either got to be 55 or disabled at that time. You can't turn 55 after the fact that the property's sold. So you got to sell the property after you're either 55 or classified as disabled. All right, so both the original and the replacement property have to be eligible for the homeowner's exemption. Basically, it has to be your primary residence. You live there in both circumstances. So how do you apply for this? How do you get this? Well, basically, there's a form that you fill out, right? There's always a form. And the form, by the way, we put the link in the description notes below, but the form, you fill this out and you send it in to your county tax assessor. So every county in the state, all 64 of them, have their own property tax assessor. And so you're gonna submit that form to them them, along with any required documentation that they've got. Every county is a little bit different, of course. And you're gonna submit that, they'll review it, and they will update your taxes based off of your eligibility. Now, you have to submit this application no later than 3 years from when you purchase your replacement property. Now, I mean, honestly, most people aren't gonna wait that long. This is like, that would have to be a scenario where like you totally somehow forgot and you're just happy paying more in property taxes in the interim. But most people, you're gonna wanna be right on top of that so you can get your monthly payment down, right? So let me give you a couple of examples of how this works as far as Prop 19 and transferring your tax basis. So let's say that you bought your house for like, in 1989 for $250,000. Now fast forward to today and that home is now worth $1 million. Now, if you want to sell your property and purchase a new property, let's say that your replacement property that you're buying is $1 million or less. So it's basically the value of your original property or less. In that circumstance, when you purchase that new property for $1 million and you fill out that form we were just talking about, submit it to your county tax assessor, your property taxes will be adjusted to what you were paying on the house that you paid $300,000 for. Yes, this is like designed basically to help people, mainly like seniors that bought their home a long time ago and now they're like trapped in it basically because they can't afford the property taxes, even though they got a boatload of equity to go buy something. So this is a great tool for somebody that bought a house several years ago, several decades ago, and they're paying nothing for property taxes basically, and they want to go buy a replacement property, but instead they're going to pay like 15 grand a year or something like that for taxes. So Prop 19, that's where this comes into play. So let's say that your replacement property is actually going to be more than what your departing residence value is. So like in our last scenario, it was worth $1 million, right? And the replacement property was $1 million. Well, let's say that your replacement property is now $1.2 million. So it's $200,000 more than the $1 million valuation of your original property, right? Because they're using the current value of the property, the sales price, basically what you depart with. So if you were selling for $1 million and you were buying for $1.2 million and you were using Prop 19, the way that it'll work is, remember, your taxes were based off of that $300,000 purchase price, but there's a $200,000 difference now. So what are they gonna do? Now you're gonna be taxed as if it was a $500,000 cost basis. So they took the original 300, they added the 200 difference, and that's now how your taxes are gonna be calculated. All right, so there's a few things that are important to point out with Prop 19 and getting your taxes lowered and all that stuff. If you're using financing, you're getting a mortgage for your replacement property, at the time of your purchase transaction, the lender is not going to factor in Prop 19. They are going to assume that your taxes will not be transferred and that you will be paying the tax basis based off of the new purchase price. So like 1.2 million, like we were just talking about. So in that circumstance, keep a few things in mind. First off, you will have to qualify using the full taxes, not the transferred taxes from Prop 19. Also, it's probably going to take the county a few months to process your application for Prop 19, which means that in the interim, you're gonna be making monthly payments to the lender. So in California, we call it impounds, not when they're taking your car, but when they're including your taxes and insurance in the monthly payment. So if you elect to have impounds, to have those included in the payment, understand that while you are waiting for your Prop 19 application to be approved, that you will be paying the higher property tax amount until that gets updated. Once it is updated, you'll need to provide a copy of that updated tax bill to your lender so they can update your monthly payment. Now, something you might want to consider doing if that's going to cause a financial hardship for you with your cash flow of making that extra payment that ultimately you're not going to need to make, if that's going to be the case for you, you may want to waive impounds, and that's where you elect to not include the taxes and insurance in your monthly payment. Just understand, if you do that, that means that it's on you to pay those bills when they come due. So you got to budget for it, you got to save for it, and you got to remember to pay it. So just keep that in mind. I hope you got value out of that. If you got further questions, put them in the comments below. Do me a favor, tap that like button, make sure to subscribe, and I'll see you on the next video.